All right. Welcome everybody to another video on the After Hours channel. For those of you that don't know, my name is Anthony. I'm a long-term investor with a passion for money, stocks, and personal finance. On this channel, I'll be sharing my insights and experiences as I track the performance of my dividend portfolio. I believe in the power of long-term investing and want to show you what it's like to be a long-term investor in today's market. Whether you're just starting out on your investing journey or you're a seasoned pro, I hope to provide valuable information and resources that will help you make informed decisions about your money and investments. Join me as I share investment strategies, discuss current market trends, and provide tips and tricks for managing your personal finances. Subscribe to stay up to date with the latest from the After Hours channel, and let's build our wealth together. Let's kick this thing off and jump into the portfolio update. So, as you guys can see on your screen right here, this is the portfolio sitting at $111,000. And if you're seeing the green on your screen, that means it's a good day to be in the market. Portfolio is up about 2.2% or $2,400. So I couldn't be happier. It's nice to see a green day once in a while. For those of you that don't know, this is going to be episode 4 of Road to 1 Million. If you're not familiar with that, essentially, I'm going to be tracking this portfolio that you see on screen right here all the way to $1 million. You guys are going to be seeing my trades, my sells, buys, dividends, and I'll be letting you know what companies I'll be buying in the future. As I mentioned in the beginning, to kick this video off, it's obviously nice when our portfolios are going up. It's great to see a green day in the market, but just with bad days, I want to remind everybody that these are normal fluctuations in the market. Whether your portfolio is going up or down today, just remember that this is a blip on the radar in terms of long-term investing. In 20 years, you're not going to remember that, hey, on this day, my portfolio jumped 2%, or this day, my portfolio dropped 3%. Stay consistent, remember why you started, and buy high quality companies that will return their capital to you, the shareholder. If you guys are interested in seeing all of my holdings, they're on your screen right here. Feel free to take a screenshot, pause it so that you guys can get a better look. And as I mentioned in all my videos, if you guys ever have any questions about my holdings or want to see a bit more analysis or deep dives on a specific one, let me know in the comment section below. Moving on from the portfolio update, let's take a look at my recent trades. They're all buys, no sells as of right now. So let's dive into it. As you can see, my first buy on your screen, and that is one of my favorite companies, Vici Properties. I bought $105 of Vici Properties, and in return, I got 3.3 shares at a price cost of $31. Every cent of this $105 was a recent dividend that I received. We'll be covering that later in the video, but I just want to show you guys the longer that you are invested, the longer you let that snowball take effect, the larger these dividend payments will get. So that $105 gets sent back to me as a shareholder, and I put it right back into my portfolio, further compounding my holdings. Next on the recent buys, and that is Microsoft. Microsoft is a company that I've talked about in pretty much all of my videos so far, and it's actually my largest holding in my portfolio. I actually just made these trades 21 minutes ago as of making this video, and I bought $250 of Microsoft. In return, I got 1.1 shares at $224. As I mentioned in a previous video as well, I'm going to continue to buy Microsoft for the foreseeable future as long as this company trades below $300. Now, with that being said, this is my own personal opinion, so I urge you guys to make your own financial decisions and take a look into anything that you possibly want to own in the future. But as for me, I see Microsoft as highly undervalued as of right now, so I'm going to continue to dollar cost average in. Next buy, we have Apple. I bought $100 worth of Apple, and in return, I got 0.77 shares at $128. Next on the recent buys, we have Berkshire Hathaway. Yes, Berkshire Hathaway is not a dividend paying company, but it is a company nonetheless that I would like to have in my portfolio. I bought $150 of Berkshire and received 0.4 shares in return at a price cost of $318. Just like another ETF that I own, Berkshire Hathaway, in my opinion, has outperformed the market for a very long time, and the management that is running the company, I'm sure we're all aware of some of them, Warren Buffett to name a few, but they have done excellent as far as acquisitions in the company, and therefore I felt as a dividend investor, I'm missing out on potential gains in the future if I did not invest in this company just because they didn't pay a dividend. For that reason, Berkshire is a new holding of mine and just was recently added like a month ago. If you guys are interested in starting position in Berkshire Hathaway, I will warn you that I do think this company is around its fair value. With that being said, I do think the company has a lot of upside and potential, and I have a lot of conviction not only in the business model, but the people who are running it. Moving on from my recent trades, let's take a look at my largest holding, Microsoft. Microsoft's currently trading at $224, which I believe is under its fair value. We're going to take a look at some of the financials and do a quick overview so you guys really understand what you're potentially buying into or you already own. Starting at the top here, we can see that Microsoft has a PE of 24 right now and a forward PE of 27. As for the free cash flow yield, it is at 3.78%, which is pretty high. In terms of Petrosky score, it's at a 7. If you're not familiar with that, we'll take a look at it real quick. The Petrosky score is a number between 0 and 9 that ranks the quality of a company. The higher the number, the higher the quality of the company. The score is determined by assessing 9 different financial aspects of the company. The company is given 1 point for each of the 9 standards being met. You can see those 9 different standards right here on your screen. Feel free to pause the video to take a look at those more in depth. Since this is a dividend portfolio, we have to take a look at the dividend yield, and it's at 1.1%. That is not nearly as high as some of the other dividend yields in my portfolio, but when you're dealing with a company as high quality as this, I'll take it. Going down the list here, let's take a look at their revenue. Their revenue has consistently increased year after year with a minor plateau in 2017. Taking a look here down at the bottom, we can see that their revenue increased by nearly 18% in the last year and over the last 10 years by 10%. As for the EBITDA of Microsoft, we can see that it resembles their revenue gain, which in my opinion is a very good sign. Similar to their EBITDA and revenue, their free cash flow has consistently gone up year after year as well, with only a minor plateau in 2017, just like their revenue. Taking a look down at the bottom, we can see that they raised their free cash flow by 16% in the last year, and in the last 10 years, they raised it by 8.3%. Factor in employee stock-based compensation, and we can see that their free cash flow greatly outnumbers how much they pay their employees, or essentially their executives, in stock-based compensation. That blue graph down at the bottom you're seeing, that's $7.5 billion they paid their employees in stock-based compensation. If we compare that to the $65 billion they earned in free cash flow, we can see that it is not a factor as far as dilution is concerned. Taking a look at their CAT to debt ratio, we can see that they have way more cash on hand than they do debt. Debt, $47 billion, and in comparison, their cash on hand is $104 billion. So this company is definitely cash rich and could easily pay off those debts if they wanted to. Moving on to their dividend, and we can see that it resembles other aspects of their business, consistently going up year after year. It looks like they started increasing the dividend in 2006, and since over the last 10 years have increased it 11.45%. While that dividend has consistently went up over the years, we can see that their outstanding shares have consistently gone down. That means the executives are doing share buybacks and they're buying back their own stock. That in return increases the price of the stock, therefore returning money back to the shareholders like you and me. Another thing I want to mention on the outstanding shares, we just took a look at their cash on hand, it was roughly $105 billion. If they wanted to buy back more shares of their stock, they easily could. That is always a better situation to be in rather than not having money and they can't buy their shares back if, let's say, there's a drop in the market like we're seeing right now. Lastly, I want to take a look at something called return on capital employed. And essentially what this is how much money the company invests and what they get in return. So let's take a look. If we look at 2022, we can see the return on capital employed was 31%. If the company invested $100, that means they would have gotten $131 back, therefore making money on their investment. The typical return on capital employed you'll see for companies is anywhere from 10 to 12%. If we look at Microsoft, we can see 35%, 47%, in one case 52%, which is extremely high. And even in their lower months, their return on capital employed is around 13, still above market average. What does that mean, you may be asking? That means that they know if they invest money, they will get money in return. They're not just burning off cash. Apple's currently trading at $130. They have a PE of 21 and a forward PE of 23. So in my opinion, I believe that this is under their fair value. As far as Petrosky scores, which we just took a look at, they're at an 8, so that is 1 away from perfect. Their free cash flow yield, 5.38, so even higher than Microsoft. And if we take a look in their balance section, we can see that they have on hand negative $50 billion. Now, Apple does its finances a bit different than other companies, and it's quite confusing, I'm not going to lie. So it is estimated that Apple has way more cash on hand than is advertised, so I'll just leave you guys with that information. As for dividend yield, Apple is paying a whopping 0.71%. So if you're looking for a high dividend yield, this may not be your kind of company. With that being said, everything else with this business for the most part looks incredible. Their revenue has consistently gone up year after year. In the last year, they increased their revenue by nearly 8%. In the last 10 years, they increased it by nearly 10%. Their EBITDA has consistently gone up as well, which you definitely want to see in a company, and resembles their revenue and free cash flow, which we'll take a look at right now. As for free cash flow, resembles the EBITDA and the revenue, we can see it has consistently gone up. In 2022, they had a free cash flow of $111 billion. So if we take a look at stock-based compensation, which I advise all of you guys to do if you're going to invest in a company, we can see that similar to Microsoft, they are not paying their executives these crazy compensations and bonuses, therefore diluting shareholders. They paid their employees $9 billion in comparison to the $111 billion that they made in free cash flow. As for their dividend, they were on a great streak, but you can see in 2022, they actually lowered their dividend yield, which if you're a dividend investor like me, you definitely do not want to see, especially when a company has so much cash on hand that they could easily pay this dividend out. While their dividend consistently goes up year after year, we can see that their outstanding shares consistently goes down. Now, if you're unfamiliar, this is definitely what you want to see as an investor. This means that Apple is buying back their own shares. This in return increases the price of the stock, therefore returning money to you as the shareholder. Taking a look at return on capital employed for Apple, and we can see that it's above the market average. So it's around that 20% mark and up. If we look at 2022, we can see that their return on capital employed was 60%. That's extremely high for any company and probably the highest out of any of the companies that I own. Now, I'm sure there's others out there that have an equal to higher return on capital employed, but as for Apple, if you're an investor, this is definitely what you want to see. Moving on from there, let's take a look at my recent dividends, which I'm sure most of you want to take a look at. So as you can see, I received 2 dividends. First dividend is going to be $34, and that is from an ETF that I own called JEPI. My second dividend is going to be $71 from a company that I've spoken about multiple times, and that is Vici Properties. All of this money was reinvested right back into my dividend portfolio, only furthering that snowball effect, which we all want to see. If you guys have any questions about these 2 dividends or possibly the dividends that you see on your screen right here, let me know in the comments below. Moving on from my recent dividends, and we're going to be jumping into something that I am going to be including in all of my videos going forward, and that is answering subscribers' questions. I'm going to at least include 1 subscriber's question in all of my videos going forward. So if you have any questions for me, you have something burning that you need to get out, let me know in the comments section and you may be included in my future videos. To kick this thing off, let's read Anthony's comment. He says, what do you think about Amazon to buy right now? Or could we see more bleeding? First of all, I want to say thank you, Anthony, for subscribing and asking that question. And secondly, I want to answer the last part of your question first. It says, or could we see more bleeding? If anybody on YouTube, anybody you know, or any financial advisors out there tell you they know which direction a stock is going to trade, run. Just run the other way immediately because they're lying. It would be inappropriate and unprofessional for me to act like I know if Amazon is going to go up or down in the future. Now, with that being said, we're going to take a look at the financials of the company to try and make a determination whether this is a good buy right now for you or for me. Similar to Apple and Microsoft, let's take a look at Amazon and answer Anthony's question. As you guys can see on your screen right now, Amazon is currently trading at $85 per share. So quite low based on their historical average. Their PE ratio is 76. Their forward PE is 43, which I believe is quite high. So I don't necessarily think this company is undervalued right now. If we take a look at their Petrosky score, which we just spoke about, it is at 4 out of 9. Taking a look at their free cash flow yield, and it's actually negative 3%. So as an investor, that's not something I want to see. Looking over here at the balance section, we can see that Amazon has on hand $58 billion and they are in debt $128 billion. That comes out to negative $69 billion. So again, as an investor, this is not what I want to see. Now, this is a dividend portfolio, so let's take a look at their dividend and we can see that it is 0%. Amazon, unfortunately, does not pay a dividend. Taking a look at the revenue, we can see that Amazon has increased their revenue year over year and it looks really good. In 2021, they had a revenue of $469 billion. So this company is earning money. There's no question about that. In the last year, they increased their revenue by 21%. And in the last 10 years, they increased it by 25%. That's quite high. Compare their revenue to the EBITDA, and we can see that they are very similar. Their EBITDA has consistently gone up as well. Now, taking a look at their free cash flow, we can see some of the kinks in the armor and where this company is not as desirable from an investor's standpoint. Since 2014, we can see that they were consistently increasing their free cash flow. But in 2021, it took a sharp decline. On top of taking a $14 billion loss in their free cash flow in 2021, we can see that they consistently increase how much they pay their employees in stock-based compensation. So not only did they lose $14 billion, but they paid their employees in stock-based compensation $12 billion. That is called dilution. Moving on to their shares outstanding, and unfortunately, it does not look any better. Yes, it keeps going up, but that's not what you want to see as an investor. This means that they are consistently issuing new shares, therefore diluting us as the shareholder even more. Taking a look at that magical financial tool that I showed you guys, return on capital employed, and we can see that in 2021, the return on capital employed was only 9%. So that's well below the national average. That's well below the average for most companies. So again, as an investor, this doesn't get me excited. This is not what I want to see. I want to see a company that can invest money and get money in return for those investments. I also want to take a look at a recent article that just came out, and it says that Amazon is going to be laying off roughly 10,000 employees. During the course of the pandemic, many large corporations were on a huge hiring rampage. They hired too many employees that they quite frankly didn't need, and that's why we're seeing large numbers of unemployment and layoffs like this in many articles. Amazon is not any different from most of these corporations, and unfortunately, these 10,000 employees are now going to be looking for a new job because Amazon hired more people than they needed. Going back to Anthony's question, is Amazon a buy right now? In my personal opinion, no, I do not think so. I'm actually not going to be buying any more Amazon until I see the financials of the company going in the direction that I want to see as the investor. Anthony, you use that information as you will. And again, thank you for the question. That, my friends, is going to conclude episode 4 of Road to 1 Million. If you have any questions about the topics that I covered today or some of my holdings or potentially one of your holdings, let me know in the comment section. With that being said, I'll see you in the next one. Take care.